Hello, it's What Would Peter Lynch Do? Time to explore the wisdom of legendary investor Peter Lynch. Today is June 3rd, and U.S. stocks closed positively on Tuesday, with the NASDAQ Composite Index leading the market with a 0.9% increase. And welcome everyone to the deep dive. Today we're really digging into some fascinating material about, well, a true legend, Peter Lynch, and specifically his whole philosophy on long-term investing. It's so easy to get, swept up in the daily market noise, isn't it? Like today's Nvidia rise is noticeable, and, congratulations to those who have held this stock for a long time. But seeing that kind of thing can make you wonder, did I miss out? Or maybe you get nervous when things head south, that fear during downturns or hesitation when things are rallying. It's something pretty much every investor feels. And the sources we looked at highlight how Peter Lynch, the guy with that amazing track record at Fidelity Magellan, he just cut right through it. He had this really simple but powerful piece of advice. He said, and this is directly from our material, the real key to making money in stocks is not to get scared out of them.
That's it right there. Not to get scared out of them. It really nails the core of his thinking, doesn't it? It's about managing those emotional reactions to, well, the market just being the market, all that short-term bouncing around.
It absolutely does. Which actually brings us perfectly to the listener question that kind of kicked off this whole deep dive. Our source material flags it. A listener asked, is the long-term investment that Peter Lynch talks about really advantageous? How many years does long-term investment refer to?
Right. So using the sources we have, our plan today is basically to unpack those two questions. We're going to explain the benefits of long-term investment and try to pin down what long-term actually means in years, all through Peter Lynch's lens.
Sounds like a plan. So let's start with the why. Why is long-term investing seen as so advantageous? What are those key benefits according to Lynch and the material?
Okay, so the sources point to a few really big ones. And the first one is, well, it's incredibly powerful, often called the magic of compounding. Ah, yes, compounding. The material describes it really well. Profit, earning more profit, like a snowball rolling downhill, getting bigger and bigger. And the key thing, the sources really stress this, is that time is way more important than just the annual return number itself.
Yeah, you can see it so clearly in the example the source gives. Say you get a steady 10% return each year. After 10 years, okay, your money's grown about 2.6 times. Pretty decent.
Decent, yeah.
But double the time, go 20 years. Now it's up around 6.7 times, and then push it out to 30 years. It just explodes. We're talking roughly 17.4 times what you started with. That growth really, really picks up speed over time.
Exactly. That acceleration is the whole point. It's why the sources wrap up this idea by saying, stock investing is also about investing time. It's not just picking winners, though, that matters, but giving them enough runway for that compounding effect to really work.
And that NVIDIA example from earlier, today's NVIDIA rise is noticeable. It kind of feels like a real-world case study for this, right? Holding a stock like that long enough lets you potentially see that compounding power firsthand.
It's a great example, definitely. But, the sources are also smart to tackle that tricky question people have about compounding in stocks. Like the listener implied, doesn't compounding kind of assume you don't lose money?
Right, because the market doesn't just go straight up.
Exactly. You have good years, bad years. You might even lose money some years, maybe even dip below what you put in.
Right.
So how does this magic work then? It seems a bit contradictory, maybe.
Well, it's a really crucial point. The sources clarify that compounding in stocks isn't about pretending you'll never have a down year. It's about the long-term potential of good companies, well-chosen assets, to grow despite that volatility.
So it's not a smooth line upwards. Not at all. It's bumpy. But the potential for that exponential growth over, say, decades comes from the underlying company growing its earnings and value. Resilient companies do that. And compounding works on that growing value base over time, even with the dips along the way. Peter Lynch's view, echoed in the material, was, in the long run, a portfolio of well-chosen stocks will rise with the earnings of the companies. The sources talk about needing that skill of endurance. Oh, you knew, basically the grit to stick it out. It's that resilience in the company and in you, the investor, that lets compounding do its thing. It smooths out the noise long term. So it's about the possibility of growth based on riding out the bumps.
Okay, that makes more sense. It's about the underlying trend, not getting lost in the short-term noise. So what's another big advantage the sources highlight for going long-term?
Well, basically, trying to time the market is mostly a waste of time.
Yeah, the classic mistake. Trying to jump in at the perfect bottom and sell at the exact top. We all think about it, don't we? Should I buy now? Is a crash coming?
Peter Lynch was famously blunt about this. Sources quote him, I can't recall ever once having seen the name of a market timer on Forbes' list of the richest people in the world.
Huh, that's pretty clear.
And another part of the material just says flat out, I've never known anyone who could consistently predict the market. It's nearly impossible. Too many factors. History shows staying invested usually beats jumping in and out. You miss the best days, and that really hurts your long-term returns.
And trying to time things constantly has other drawbacks too, right? Like costs and stress.
Oh, absolutely. Trading a lot means paying more fees, more commissions, and more taxes usually. Every time you sell for a profit, that's potentially a taxable event.
Right. Eating into your actual returns.
Exactly. The sources even suggest that sometimes just staying put, doing nothing, actually leads to better net results because you're not constantly chipping away at your gains with costs. And then there's the emotional side, big time. The sources point out that trying to time the market often comes from fear or greed. Selling in fear, buying in greed, those emotional reactions. Almost always the wrong move for long-term success.
Which loops back perfectly to Lynch's advice, right? The sources mention him saying, information, not emotion, should be your guide. And that other critical one, know what you own and know why you own it.
Precisely. If you have a long-term view, if you've done your homework on the companies, understand why you invested, you're much less likely to panic sell during a dip or chase some hot stock during a rally just because everyone else is.
You're anchored.
Yeah, you're anchored to the company's fundamentals, its long-term story, not just the daily price swings driven by crowd psychology.
Okay, so if you're not trying to time the market, what should a long-term investor be focused on based on Lynch and these sources?
It shifts the focus entirely. It becomes about the company itself, its underlying value, its potential for growth over the long haul. Lynch was huge on fundamentals, keeping it understandable. And that line again, know what you own and know why you own it. That's the core of it. Understand the business, its finances, its competition, its future prospects. If you find a good company, buy it at a fair price and believe in its future. Well, then you can follow that strategy mentioned in the sources. Buy good companies cheaply and hold them for a long time. Believing in that value helps you ride out the inevitable market swings.
Okay, that paints a really clear picture of the why. You get compounding, you avoid market timing traps, you lower costs, manage emotions, and focus on company value. Which takes us right to the second part of that listener's question. What does long-term actually mean? How many years are we talking?
Yeah, good question. And the sources show there isn't one single answer. Kind of depends. Like in finance circles, academics, or maybe certifications like the CFA, they often talk about 5 years or more as being long-term. That's a pretty common benchmark.
Okay, 5+ years. What about Peter Lynch himself? Did the sources say what he thought?
Yes, he gave a more specific range from his own experience. He apparently said you need to be ready to wait at least 3 to 5 years, which fits with that other famous idea of his that you need more stomach than brain power. You need the patience to wait out that minimum period.
3 to 5 years minimum.
Yeah.
That's interesting.
And then you can contrast that with, say, someone like Warren Buffett. The sources bring him up too, his famous line, our favorite holding period is forever. That perspective is, well, even longer, decades potentially. Thinking about holding as long as the company itself is viable and growing.
Wow, okay, so 3, 5 years, 5+ years, maybe even forever. Why such long time frames? What's the reasoning behind needing years?
The sources explain it's really about how markets behave. Short term, they're all over the place. Wild swings. The S&P 500 might be up 20% one year, down 15% the next. It's unpredictable day to day, year to year.
Right, just noise.
A lot of it is noise, yeah. But zoom out, look at the long-term decades. And historically, markets tend to trend upwards, generally reflecting economic growth and company earnings, maybe averaging, 7, 10% a year over very long periods. You need that multi-year time frame, that 3 to 5 years minimum, ideally longer, for the company's real value to show through, for compounding to really kick in, and for all that short-term volatility to kind of average out.
Got it. So pulling it all together from the sources, there's no single magic number for long term, but the consensus is clearly way beyond just a year or two. Lynch talking 35 minimum, finance pros often using 5+A, deep value guys thinking even longer, but the underlying idea is the same. You need significant time for the strategy to actually work.
Exactly right. The specific number might vary, but the principle of giving your investments substantial time is absolutely fundamental.
Okay, this has been a really insightful deep dive thanks to these sources. So just to recap quickly, Peter Lynch championed long-term investing because One, it harnesses compounding, letting returns build on themselves over time, even with market bumps. Two, it avoids the futile game of market timing. Three, it reduces costs from frequent trading. Four, it helps control those emotional decisions driven by fear and greed. And five, it keeps your focus on the real driver, the company's fundamental value and growth.
And time frame-wise, the sources show it means years, not months. At least 3 to 5, according to Lynch, often 5+ in finance, potentially much longer from a value perspective. Patience is key to let the company's value and that compounding magic actually play out. And the sources offer this really great closing thought, which I think sums it up nicely. Long-term investing isn't passive waiting. It's an active skill, the skill of enduring. It means choosing well, believing in your choices, and having the discipline to stick with it through thick and thin. It's a test, really, as one quote puts it. Stock is a test of patience. Time and belief are the best weapons.
Stock is a test of patience. Time and belief are the best weapons. That really resonates, doesn't it? I will say a word from Lynch today and say that this principle is connected to not only investment decisions, but also life wisdom, which leads to maybe a final thought for you, the listener, to consider. If enduring fear and believing in long-term value is key in investing, where else in your life could that same patience, that same belief, that same skill in weathering short-term difficulties unlock, real long-term fulfillment or growth? Something to chew on. And I will end with, see you next time. This was What Would Peter Lynch Do? Thank you for joining us today.